Hi everyone, this is Paul Stewart here from Segmented Solutions and Elite Wealth Services. I'm just wanting to run you through a quick presentation about GDCVs. I'm not going to go into detail as to exactly what they are in this video. There's another video that does that for you. But needless to say, people are looking at investing their money inside their SSAS pension scheme and want to know how they can stray across the line into doing things not allowable within a SSAS. And I explained that you can do a lot more within a structure called a GDCV, which sits inside your SSAS, and there's various costs involved. So this video is all about, is it worth your while? Is it actually something worth looking at in terms of the costs and the benefits? And the key thing here is that you're needing to compare. There's no tax or SSAS restrictions versus the costs of paying to get into a GDCV. So let's have a little look by what I mean by SSAS restrictions. If you have a SSAS and it has 200,000 in the bank account and you want to get involved in property investing, then everyone across Facebook and across all social media keeps on bleating on about loan back this, loan back that. And actually in most cases they are just not appropriate. So how do you get the freedom to invest in any property transaction that you like without falling foul of the SSAS pensions rules? And as I've said in other videos, the way you do that is by using a structure called a GDCV. But right up front, if I was to say to you that it's going to cost you £13,310 to set up, establish and move your SSAS money into the GDCV, most people would go pale, they would fall over, sit down, run away. But what I want to do is to compare that cost with the actual benefits, and by the end of this little video you'll see that actually having a GDCV potentially gives you the opportunity to invest in more property, so you end up with an additional £67,000 worth of equity within your pension scheme. Also, you can get a higher amount of rent because you're able to buy properties at a higher value. So all of a sudden the payment of £13,000 suddenly becomes a very good investment, because if you were to put £13,000 into the bank, next year it would be £13,000 minus inflation. Whereas if you were to put £13,000 into the cost of setting up a structure and you were to use it properly, then you'd actually end up with a lot more equity. So the question here is, what do you want to do with regards to property? Where's your skill set? Are you involved in buying commercial and then converting it into residential? Are you involved in refurbishing places, turning them to HMOs, serviced accommodation? All of those sorts of things are also very important, because there's no point having a GDCV if you have no intention of getting involved in property transactions that are going to give you the financial rewards. So here we go. Let's have a little look. First of all, a SSAS, really important, the reasons why you should have concerns and why you should be looking at doing something different. First of all, a SSAS can only invest in commercial property, and I caveat that with a statement which says, unless you're using one of the allowable exemptions, which is what a GDCV is. Most people who come to me talk about loan backs, and those loan backs require a first charge on a commercial asset, and people have made their minds up, they want to do loan back, they phone me up and they say, right, I want to do a SSAS because I want to do a loan back. And when I talk to them about a first charge security being needed, they say, but I don't have a commercial property. So it rather bursts the bubble of the loan back. Second thing is, you're only using 50% of your money, and if you're seriously wanting to get involved in property, actually making use of all of the money is a massive benefit in terms of your planning. The other thing is, with a loan back, it's over 5 years, and it's not just the interest. You have to actually make capital repayments. So your property business that you're wanting to run, in inverted commas, has to have the ability to make those payments. Otherwise, there's unauthorized taxes that will be applied to your SSAS pension. So it's not just about I want to do a loan back and I want to play with 50% of the money. It's down to, will you be able to afford these very chunky capital repayments? Because repaying a loan over 5 years is hefty work. The other thing is, a SSAS is not allowed to buy, flip and trade in property. It's not like a business. It cannot operate. If you buy commercial property with the intention of turning it into flats, then that's a business, that's a trade. Whereas if you buy commercial property with a tenant who's going to be in there for 10 years, that's an investment. Pensions are about investments. And there's a lot of people who are effectively running their pension as a business, and they are actually told, treat it as a business, which is why the Inland Revenue would come knocking on the door, ask some questions, and then you'd have to pay corporation tax on all your profits. The other thing is a SaaS is limited in terms of what it can borrow. Everyone talks about gearing up in terms of property transactions, and a SaaS can only borrow 50% of its own value. So you are limited in terms of what you can do inside a SaaS, even if you've moved away from being obsessed about loanbacks. The other thing is, where you buy commercial property and it's going to be changed into residential, if the SaaS is involved and the SaaS owns the commercial property, you've actually got to exit the entire transaction prior to it becoming residential. And for that, you may need to use expensive finance, or you may need to actually sell the entire project, and it goes outside of the pension and it puts the rent and any future capital gains firmly into the tax bracket of being taxed, which defeats the whole object of doing doing property inside a pension in the first place. The other thing is, any of these future gains, once you've sold the deal outside to another company, starts being suffering inheritance tax. So these are the SaaS restrictions, and a lot of people really don't appreciate how restricted they are. The flipping, the trading, the running your own business, and the loan backs are the most common ones that people come up and say, well, I've been told I can do this, I've been told I can do that. When it comes to Facebook, I've been told that the earth is flat, so I wouldn't necessarily take that as your source of information. So let's look at GDCVs in terms of their freedoms. First of all, a GDCV can invest into any property. It can be absolutely residential. The only issue is you can't live in it as your home. And it can use 100% of your SaaS money. You're not restricted to only using 50% as you might be thinking with a loan back. There's also no large annual repayments. Your SaaS would be buying into a GDCV. There is no loan from the SaaS to some strange structure. It is literally your SaaS will purchase something which is your GDCV, and you don't have repayments to make. So from a property and a cash flow perspective, it's a lot better. A GDCV is expressly absolutely allowed to buy, flip and trade. So if your intention is to run a business where you're buying, refurbishing and selling, which would normally be subject to income tax, then you can't do that in a SaaS, but you can do that within a GDCV. Also, a GDCV can borrow as much as it wants. It can go and get a mortgage of the bulk of the purchase price, and your SaaS money, which goes into the GDCV, is your deposit. So you've actually got a much bigger scope for looking at properties. The GDCV can also borrow from you personally, or from the sponsoring employer or any other lender. It's absolutely got no restrictions whatsoever, as long as the loans are detailed with the correct documentation. And for people who are doing conversions, the residential conversion can stay inside the GDCV rather than having to be stripped out of your SaaS. So there's no tax on residential rent, and there's no future capital gains on the residential property. And in addition to that, you've saved the IHT on the value of the assets, which with a SaaS would have to be stripped out of the pension if it's residential. So the GDCV has a lot of freedoms, but those freedoms come at a price. And what this video is going to do is take a really simplistic but hopefully fair view of the whole thing in terms of comparing like with like. So let's have a look. The GDCV establishment cost £9,500. There's no VAT added to that, by the way. Plus 2% of the amount of cash going in, which is a subscription fee for subscribing to the units of the GDCV. And there's a 2% annual audit and accounting fee, which is based on the net asset value. So if you put 200,000 in and then you borrow £1 million, which is perfectly acceptable, the 2% bit would be based on the 200,000 rather than on the £1 million, because a loan coming in gives you money which you turn into bricks and mortar, but on the flip side there's the debt, so they cancel each other out. So I'm going to look at a case study, relatively simplistic, and there's lots of little twiddly bits that you can come back and say, oh, but what about this? What about that? This is conceptual without trying to actually go into massive amounts of detail. We're going to assume that if you buy a property, it will always generate an 8% rental yield. So if you buy it and do it up, it'll generate 8% of the new done up value. And the other thing is, if you buy a property and you refurbish it, I'm going to assume it'll add 25% to the value of the property. So very, very simple, 8% rental yield, 25% refurbishment yield. So let's see which one is better, net of all the costs. So we start off with a SSAS with 200,000 to invest. And the 200,000 that it has to begin with is allowed to be geared up, and it's allowed to borrow an additional 100,000 because that is the absolute maximum that it's allowed to do. So it's now got 300,000 available for buying property. If it's in a SSAS, it has to be commercial property. So 8% rent on 300,000 gives you £24,000 a year rent. No conversions or flips allowed because it's not allowed to run a business. But imagine you refurbished it and you did something to the commercial property. We're going to assume the 25% uplift, which will be exactly the same percentage uplift when we look at the GDCV. So your 300,000 has now gone up to 375,000. And if you rent that out at 8%, you've now got £30,000 of rent coming in from what was an original £200,000 invested into the SSAS. So now we're going to look at a GDCV, and again, same SSAS, starts off with £200,000 and it pays the £9,500 establishment fee. Then that leaves £190,500 to be invested into the GDCV. So that's where you get the 2% subscription fee, which is another £3,810 in fees. That leaves you £186,690 in what is effectively a tax-free property company with none of the pensions restrictions on residential or commercial, none of the borrowing restrictions, and you can actually flip and trade. Now, it may seem like a big price to pay, but actually this is a bit like the tortoise and the hare. This starts off slow but rapidly catches up. So it's allowed to borrow any amount that it likes. So in this case, I've used the 186,000 as a 30% deposit, and the rest of it is by way of borrowing. So that now means that the GDCV has got £622,300 to go shopping with, which is a lot more than the SSAS. And if we stop there and we didn't do anything to the property, that's £49,000 of rent, again assuming the same rental yield. Note there, any property, out and out residential, absolutely fine. As long as it's not a home for you to live in, then everything is tickety-boo. Then, if we do the same as before, we refurbish the property and we get a 25% uplift, you're now looking at £777,000 worth of equity inside your GDCV. There's no tax to pay because it's part of a pension scheme. And now if you rent that out, your rental income is £62,000. So it's an awful lot more rent and an awful lot more equity because you've been able to gear up more. And even if you take off the GDCV annual costs, take those off, you're actually left with £55,385 of rent. And again, in this, I'm being simplistic. I'm ignoring broker fees and I'm ignoring mortgage fees, etc. I'm just trying to give you the concept, which is the GDCV may cost a bit up front to establish, but once it's there, you now have a property business. You can actively do all of the property strategies, and you can do all of those in a totally, utterly tax-free environment. But let's have a look side by side. We've got the SSAS and the GDCV. The SSAS has accumulated property value of 375 because it's got its uplift because it's done some refurbishment. The maximum loan that it can get is 100,000, and I've just picked 5% interest out the hat. That means that you've created £275,000 worth of equity from your starting SSAS pot. And that gives you 30 grand of gross rental income. And if you take off the loan costs, again, I'm keeping this really simple, 5% interest on your 100 grand, that gives you £25,000 worth of profit on your rent. Again, tax-free. So that's your traditional commercial property sat inside a SSAS. It's done a bit of work, it's increased the value, and it's rented it out. But with a GDCV, you've got a much higher property value because you're allowed a lot more borrowing. And in this case, you do have a lot more borrowing. You've got 435,610's worth of borrowing. But again, I'll be fair, treat it exactly the same way, 5% interest. So you've created more equity within your structure. You've got higher rent. You've obviously got higher interest costs, so you need to take those off. and therefore your profit on the rent is 33,604. So side-by-side comparison, what you've got is the GDCV gives you £67,000 more equity, and that's after cost, that's after spending all your money setting the thing up, and you get more rent, 34% more rent, and again that's after taking all of the costs and charges involved. So yes, something may cost a little bit, but you are able to do special things with it. It's a bit like a Ferrari costs an awful lot more than a Mini, but the Ferrari will get you around the Formula 1 racing track a lot quicker. So it depends on what you want to do, and it all comes back to, are you a property entrepreneur with the skills and determination to run a property business? And if the answer is yes, then this could be something for you. And if you want to do it in a totally tax-free environment without having to mind your P's and Q's with regards to commercial versus residential, this is again another reason for looking at the GDCV. I've done separate videos on HMRC reporting that explains in real detail what a GDCV is, but it's a term that in this particular case refers to a unit trust. So your SSAS will be buying units within a unit trust, and that is, as far as your pension scheme is concerned, a perfectly allowable, perfectly acceptable investment to make. The unit trust provider then lets you play with your money inside a company where you can do all your borrowing and do all your property and apply all of your property skills to build wealth, but within a tax-free environment. So there we go, that's just a quick run through side by side SSAS versus GDCV, taking the costs into account. I hope that was helpful, and I hope that now you've got the trilogy of GDCV videos, you'll be able to sit and watch them and make a choice in terms of what you want to do. So it's really boils down to, is it worth not having one? Because if you think about it, it's using very specific HMRC exemption. So there's less risk than trying to create a loan back secured on something that actually is residential all along. And again, I mentioned this in my HMRC reporting video. There's a lot of loan backs out there that are just totally delinquent and will fall over at the first provocation. And it lets you invest into any property, whether that's residential, commercial, mixed match. You don't need to title split, so you're saving money on solicitors' costs. So any property, and you can trade, you can actively buy stuff, do it up, flip it on, reinvest the money, all within a tax-free environment. And of course you've got massively different borrowing levels within the GDCV. So if you are serious about property, then a GDCV is very, very useful. If you're based offshore, your GDCV can actually be inside a QNUPS rather than inside a SSAS. So we've got offshore buyers covered just as well as UK buyers. So there we go. My name is Paul Stewart from Segmented Solutions, and we deal with SSASs. We look after many SSASs, and I've produced training courses on SSASs and what you can do. Now I've done the trilogy on GDCV. So have a little look. That's my details. I've got my email address, mobile number. The Smart Business Card there is a digital business card. Tells you all about myself, Segmented Solutions, Elite Wealth Services, but I also embed and put all of the videos into that digital business card, and they're kept live and updated. So I hope this is of some use, and all the best in your property journey. Please don't hesitate to ask us any questions. Cheerio.